Welcome to this week's edition of Halftime Talk. I'm honored to welcome as our guest Mr. Martin Houston, who is known to be on multiple different boards, globally well known as Vice Chairman of Tellurian. He's also well known in the Middle East as part of the CCED board in Oman and many other distinguished honors that he has achieved in his career. Martin, thank you very much for joining us on Halftime Talk.
Thank you, Sean. Thank you for having me. Glad to be here.
It's an opportune time to have your voice at the table because we've obviously come through a rather, not to say unusual few months, but nonetheless, the entry into the lockdown and the COVID pandemic crisis did seem to be rather orderly and consistent across the world. The sort of self-isolation and lockdown strategies were all quite similar. The exit, however, does appear to be a lot more disruptive than maybe would be appropriate. How do you see that yourself now in these early days of June?
Well, yeah, that's a very good question, Sean. And, you know, I think you're absolutely right. I think we got into this with relative ease, a little chaotic, perhaps, a little unexpected and abrupt in some places. But it's the getting out of this that's proving to be, you know, what I've said to you is a Herculean task. You know, if you go back to March, you know, we've had this kind of surreal calm, stasis, you know, globally. And I've likened this to the frontal edge of a glacier, which is just peeled off in slow motion, very powerful, catastrophic, emotional, irreversible, and huge. And that's what's, you know, what this big stop, and I'm grateful to whoever it was who gave me that phrase in the first place, because I think it's brilliant. The big stop. And getting out of this is just going to be such a big challenge. It's not homogeneous, it's multi-speed. It's very political, fiercely political. And, you know, I'd venture that science, you know, is been weaponized to a degree, and you know it's become political, and it's not in itself and in a lot of itself a short-term solution.
I suppose when we came into this crisis, we came into it with a fairly consistent, as you say, the face of the iceberg. We had a fairly solid economic outlook for the world. We're coming out of it with the backdrop of an economic collapse. So I suppose the stress of that, which didn't exist on the entry to the lockdown, now is omnipresent and essentially overwhelming everything.
It is. I mean, look, you know, what's the global tab today? You know, if you add in the 3 trillion, you know, US stimulus package that's going through the motions at the moment, that could be 10 trillion on a global basis. And I mean, look, I've got a very simple question. You know, who's going to pay? How do we pay for that? You know, think about the consequences of this taxation on a personal and corporate level. Think about the pensions debate. Neither of those have even started. And, you know, I suppose what I'd say to you, Sean, is that it feels like the other shoe hasn't dropped yet. It looks as though we're still sort of in this sort of surreal phase, you know, waiting to face up to the realities once we get out of COVID. You know, and as I've said, that, you know, that's going to be multi-speed. It's going to be different in one place, different in another place. You know, people themselves will start to make, I think, their own choices. Now, of course, this is compounded in the United States today by, you know, a degree of civil disobedience that's going on with respect to the tragic death of George Floyd. And, you know, that sort of compounds the problem to an extent, but also signifies that people are going to be mobile if they want to be. You know, people will decide. And I think, you know, the way I've thought about it is people are going to start managing their own risks. You know, they want to get back to work in America and other places. And, you know, this notion of these circles in the park, I don't know if you've seen the images of parks with social distancing circles drawn in them as to where people should stand and sit to be separated from one another. I mean, you know, my metaphor for that is that those circles will disappear as quickly as the paint that put them in place in the first place. So, the exit is going to be different in different places. It's going to be different, driven by how people have been treated during the lockdown and how they're being allowed out.
And what about for our industry? I mean, we came into this crisis with the oil and gas industry in pretty good shape, you'd say. The oil price had recovered to a nice, comfortable level after a few years of supply management by OPEC plus. Generally, everything was in a relatively stable place. And of course, the US energy, oil and gas industry was booming with shale, and the US had become the biggest producer in the world of oil. Now, what do things look like? How do you see the industry within the US in particular, and particularly now on the exit from this crisis?
Yeah, very, very good question. I mean, I think, look, I think the people that know me know that I've been, very bearish in this during this crisis and thinking about the future. And for very obvious reasons, supply exceeds demand by a very, very, big margin. The question is, how quickly is demand recovering, and how long will supply discipline post OPEC plus and post, of course, the additional cuts from the non-OPEC countries? How long will they remain? And if there are some price signals that incite a sort of, sanction busting, if you like, or sort of cheating against the OPEC quotas, what happens there? What happens with the inventories that we've got, 1 billion barrels plus in storage? All of these, feel like bearish sentiments to me, and I don't see demand catching up at the speed which is indicated by an oil price of where it is today. I mean, I just don't see the.
Well, you're sitting in Texas, well, sort of, if you like, the coal face of the shale revolution and its implosion. Do you not draw some confidence for the oil price given the scale of and the speed in which shale has been shut down?
I mean, look, I take comfort from some of the cuts that have happened. I take no comfort or pleasure from the number of companies that are going into Chapter 11 and are facing bankruptcy. But I do sense, rather curiously, optimism which belies the supply-demand situation. The commentary is much more optimistic. Now, there's nothing wrong with that. And, in many of the things I do, a high oil price is going to be great for our business. So bring it on. I just don't understand why it exists at this level today and whether that's sustainable. And, for those that, in my particular case, sit on energy boards where we have to make decisions about the future, false optimism is no good for us. What we need is a sort of stable set of prices, which we can look forward to, which balance the fundamentals in a way that we can, logically track them and make decisions accordingly. I just feel that we are in a place where oil price is trading higher than I would have expected at this moment in time.
Well, one of your boards in Oman obviously would be quite pleased to see Oman crude trading at $40 a barrel. It's kind of hard to believe that in a few short weeks it has gone back there. However, you did mention in your earlier comment that $10 trillion of stimulus that has been essentially new cash printed by central banks across the world over the last 2 months. And maybe more to come. This is a tsunami of liquidity that has only one place to go, perhaps, and that's to create elevation in the markets, no matter what the asset class. How do you consider that on the boards you sit and factor it in?
Well, I mean, as we look at it more generally, the stimulus is causing, it's keeping people, in and out of work situations. So let me just, roll that into something practical. So in the middle of last week, we saw two 500 plus Dow days in the United States at a time when 40 million Americans are out of work in some form or another, and where we are facing the prospect in the short to medium run of 20% unemployment. The Dow, I think, closed the week 3% up. That feels like,
it nearly feels immoral in some way.
it doesn't feel right. And the question I'm being asked, and I am asking of others, is what is it about the equity markets today that is attracting capital at this moment in time? And I think most people are finding it hard to answer that question. I'm certainly finding it difficult to understand. And what I guess, sort of bringing it back to our thematic about observations coming out of COVID, we're seeing a lot of things that are idiosyncratic, that it's, we're sort of poised waiting for this second shoe to drop. And what happens when that does? I mean, is there a big shift or a big correction that we can expect or we haven't seen? Or, are we through it? It just feels to me that, once the realities of Q2 numbers start to land, that surely, we're going to get out of what feels to me like an economic twilight zone right now and into some form of, absolute reality, which, confronts the fact that we've got all of this debt to be repaid. We've got all of these people globally out of work, and we've still got to get through, the COVID crisis, which we're only partway through at the moment. And of course that, doesn't even ask the question about whether, we see a winter repeat. It doesn't, answer the question about how we get people back on airplanes again, or even the question of whether that is necessary for business going forward, given the radical changes in the way we've worked that we've seen. I mean,
there are points in which to sort of identify as sort of tangible demand recovery. It might be different. For example, reports out of the US over the Memorial weekend, generally, fairly positive gasoline consumption figures. We've seen, instead of people looking to get back on airplanes, they're buying camper vans and RVs. I mean, not everybody's doing that, obviously, but anecdotally, people are willing to put $100,000 down on the table. Those things aren't cheap at this particular moment in time. China's demand, or China's import levels, has remained pretty solid through the first 4 months of the year, despite all of the dramas that they faced. So there is some real demand signals there. And of course, at the same time, quite massive supply reductions. I mean, basics of supply and demand tightening, prices go up.
Well, that's fair enough. I mean, but China's only one of the demand centers. What do we think it'll be if we take 100 million barrels has been a round number of global demand? Is it 80 million by the end of the year? Is it 90 million by the end of the year? Whichever, is it 95? Whichever way you look at it, there's a big gap between 90 and 100 when it comes to barrels being produced. When you add that to inventory, when you add that to the OPEC cuts, you've still got a big gap to deal with. It's still a big question for me as to why the oil price wasn't lower for longer. Why we've had this bounce. I mean, why we've had this reversion to $40 coming in certain blends in the Middle East. Why we've had a reversion between the blend prices themselves. I mean, the relativity's changed as well.
And WTI, as you say, WTI is essentially compressed to Brent levels, where it's been trading for most of the last few years at a discount to Brent, and that's closed, and it's hard to even explain that.
Absolutely. I mean, lots of things, lots of things which I find confusing. And so, look, as we look forward, Sean, I think that we raise a lot of questions for ourselves, some big questions about the use of technology, the way people work, about how people travel, how they vacation, how we, supply chains, inshoring, onshoring, and so on. All of these big questions that have come out of this. Climate change, I mean, a huge issue. I mean, does this moment in time, when, the global population has seen a once in a generation, what it's like to have clean air on a daily basis, does that trigger some sort of societal response into driving more effort towards climate change? Because that's a real choice for the politicians coming out of this. Do they choose to invest in that versus the other things that will be facing the decision makers, as we get back onto a level
I think
playing
one of
field.
the unfortunate things at this moment in time is that the world isn't blessed with great leadership. And that's everywhere. I'm not just pointing at the US or anywhere. I mean, it's hard to see. And as a result, we haven't seen the G20, the G8, the G7, or whatever we saw 10 years ago in the credit crisis. The G20 played a very significant role in coordinating a recovery. On this occasion, we don't really have that multilateral platform to coordinate a global initiative. Leadership isn't present at the moment, which adds a layer of confusion, I think, a layer of uncertainty.
Look, I agree with that. And I think, you've got to look to the institutions to drive some of this. And the question is, how solid are the institutions? I mean, look what's happening to the WHO. One could argue that it's not that the institutions themselves, which are very necessary and relevant, have got to be modernized as part of this as well. They've got to get, on track with the way the world is going to be looking in the future. But these are necessary vehicles for things like climate change, for things like the global economy. The IMF, 100 countries, reaching out to the IMF for bailouts of one form or another right now. These are very, very relevant in key institutions. As we retreat to borders, and as we see globalization potentially, reverting to nationalism, and nationalism reverting to tribalism, and what does this retreat do for institutions, for global cooperation, for global trade? Now, I think the good news is that actually there are signs that globalization might actually not be in reverse. It may actually be, as a result of what we've seen in COVID. Actually, it may be that globalization just looks different than it did pre-COVID.
Well, maybe it just needs a new name, because that name has certainly got dragged through the mud and continues to be a bad name ultimately. If we might, Martin, just talk a little bit about the US energy industry. We went into this crisis with the US, reclaimed the world's largest oil and gas or energy producer, oil producer. It was also this sort of, I think, somewhat distracting label as energy independent, but nonetheless the label that got associated with this time period for America. I'm wondering, do you subscribe that it did get to that point? And is that over? Was it a false narrative that US energy independence, quote unquote, was achieved on the back of a false economic model of OPEC elevating an oil price that the US energy industry just isn't equipped to sustain when you remove that OPEC support?
Well, look, I think there's a couple of questions in there. I mean, what is the the equilibrium oil price, on a global basis? And it isn't the lowest cost of supply. It's some aggregate. I mean, the comfortable level, if I were to venture a number that seems to satisfy all of the proponents and stakeholders here, somewhere in the sort of $50 to $70 appears to be the right kind of balancing point for oil, and that stimulates new demand, and it also satisfies on the supply side as well, because some barrels naturally are becoming more expensive as we go through time.
But even at those prices, shale investors were not getting any kind of a return on the amount of money they were putting into the Permian and other places over the last 10 years.
Look, I think that's a fair point. And I think, look, not all shale is created equal. I mean, there is a seriatim from, very, very valuable shale in the richest parts of the Permian Basin, to those that are on the periphery. And of course, then you have the gas factor, you have the gas basins, you have the associated gas, all of which compound, those economics, and also infrastructure. I mean, the infrastructure coming out of the Permian Basin is as relevant, as the cost of supply in the first place, particularly with respect to gas. So all of those things play. Now, do I think that, capital has given these companies, too much leeway? Probably yes. And do I think that coming out of this, there will be more capital discipline? Will capital be as freely available? Probably not. will capital to the sector, the whole sector, forget shale, just look at the whole energy sector, will that be as available as it was pre-COVID? Possibly not. I mean, the whole ESG debate, the climate change debate is playing into those.
So as that becomes the question where I'm sitting in the Middle East, looking to the US, as we get above 40, perhaps in the next week, with the momentum that we're under, will we see shale start to recover as quickly as the oil price has recovered, or is the capital availability just institutionally not coming back to this sector? It was going to go away anyway, regardless of COVID, and it will not return for a large segment of that weaker part of the shale play.
I think for the weaker part, you will see capital evaporate. But I think for the stronger parts, I mean, remember, a lot of these are sponsor companies who are heavily invested already. So you still have the, double down question. So
Chevron, Anadarko.
Well, Anadarko no longer, of course. But look, I think my sense is that the capital returns more slowly, and the supply response coming out of the basin is slower than it was in the last downturn. So I think if you're going to take 15, 16 as being some sort of proxy, I think it's slower. But I am sensing, living here in America as I do, a sense of optimism and a sense of, we're going to get this back. And, certainly, a far more bullish outlook than you're hearing from me. Certainly fewer questions. I mean, a very sort of...
Well, you might find that the politics, which are obviously big this year with the presidential election, whether it's Democrat or Republican, both would probably, I mean, they share one thing they'd say generally is that we need to keep China under some kind of new containment, but also we need, both political ideologies have become attached to this concept of energy independence and all of the associated jobs that go with it, of course, that the Democratic administration may be as supportive as Obama was. Obviously, he set this train in motion, that the energy sector might get support from the politicians to return America to the 13 million barrel a day point, and i.e. put pressure on their allies in the Gulf to keep oil prices up by cutting more supply.
Look, I think you're going to see, different strokes depending on who's elected in November, and whichever way, whether we like it or not, there are going to be different approaches to the energy industry more broadly, and that covers everything from climate change on the one hand and carbon pricing to to support for the energy industry, which has been fairly robust in recent years. It's hard to predict because I think as we get closer to election day, the narrative gets tighter, and the two narratives will come closer together. There are a lot of people working in the energy industry in America. A lot of them have lost their jobs, particularly in and around Houston and in West Texas, and that will be important for the politicians to acknowledge. I mean, I think the question of energy independence, it has a nice ring to it. But is it a reality? Does it really mean anything other than bragging rights? I'm not sure. I mean,
well, certainly it's created some kind of a political narrative that, like, a number of others, whether it's real or not, becomes secondary to the perception that it exists, and then politicians sort of grab hold of it. But one of the factors of energy independence, again, to use that word, but none that is counterintuitive in a sense, is that the US became an exporter of both LNG and oil in this period of the last number of years, quite significant players, and the expectation was that was going to grow and grow. LNG into China, oil into India, some very, very unprecedented developments. What's your outlook for that, given the bearish posture or even a bullish one? How do you see the future of that?
Well, look, I think forgetting the numbers around energy independence or otherwise, I mean, I think we will see oil production, come back. Will it come back to the same levels as pre-COVID? I don't know, perhaps not. But, you know, it will come back. This is America. You know, it's a place where people get things done. And my sense is that this gets done. We also have the, you know, we haven't touched on it, but the global gas industry. I mean, one thing that, you know, has been clear to everybody is that in this period of reduced demand that we've seen very low LNG prices, that was partly coupled by, you know, a large amount of supply coming on in 2019 and playing through the system. But we are seeing demand increase. You know, to your point about China recovering, LNG demand year on year is increasing. Low prices stimulate that demand. So on the macro basis, the LNG industry is going to pull back, and at some point, FIDs will be required to find the LNG, or to produce the LNG from, let's say, 2024 onwards, that the world will be calling for as it moves to its low carbon economy. And the United States, to your point, is going to be a very important part of that, because we have stability, low cost labor, rule of law, access to capital, location, you know, supportive administration, supportive policies, and so on and so on. There are many reasons why the US has become such a...
It was interesting this week to see one of the big headlines that sort of got buried under all the other noise, but Qatar Petroleum putting up $20 billion for the biggest LNG tanker fleet as they regain their position as the world's largest LNG producer.
Well, yeah, sure. As they seek to regain their position.
It'll take a while, but nonetheless, they're on the pathway towards it. They're putting the money on the table.
And the good news is, I think, for the United States is that we don't compete. We're not competing with Qatar. We actually need a Qatar. We need the US projects, and we need the other projects as well. I mean, the growth of the industry is such that it needs access to high quality, low cost supply, which is reliable and on a long-term basis. And the United States is going to be an important part of that jigsaw, as is Qatar, you know, as will be other geographies as well. You know, as we
you did reference there once or twice the long-term contract, that architecture, which the LNG sector, it seems to be moving away from that, where the spot is emerging into being a much bigger part, the flexibility, the liquidity. Rather than the old model of LNG, which obviously was very long-term, 20, 25-year contracts. Do you think that trend continues?
Look, I think we will continue along a journey, which is that the customer will determine what they are looking for, and the industry will be obligated to supply that to the customer. If they want shorter tenor, then the industry will have to find a way of financing that and giving it to the customer. If they want equity, they want to be part of the supply, then we will have to find a way of delivering that. If they are looking for low volatility in integrated projects such as Tellurian, then, you know, that will be available to them. So this is very much about what the market demands. But above all, Sean, this is about low cost. Because ultimately, you know, what matters going forward in the energy industry are a number of things, but paramount amongst them, be it oil, gas, or any other product, low cost of production, low cost of supply matters in the future. And the United States is well positioned to deliver that.
Well, certainly their constant surprise in their ability to innovate is massive. Let's just wrap up, Martin, where we started. It's June. We're looking at the second half of the year. Q3 is upon us. It looks maybe like one could see through Q3 where it might go. Q4 looks a little bit foggier to me, at least. How do you see the second half of the year, at least as much as you can in your crystal ball at the moment?
So I see, you know, an emerging reality. You know, I think the fog clears. It's not cleared at the moment. And as we look ahead, as I've said on this call, you know, I think the realities that we are facing begin to confront us. And I think we will have to face up to the 10 trillion reality. We will have to face up to long-term unemployment. We will have to face up to where is capital deployed by governments. You know, we will have to face up to whether climate change becomes a key pillar of the post-COVID recovery. You know, lots of other big choices too, how we work, where we work, you know, and so on. You know, one thing is for sure, the world is not going to be the same as it was at the beginning of March. You know, by the time we get to December, the world will look differently. I heard somebody say on a call this morning that what we will have accomplished in months, what would under normal circumstances have taken years. And that has to be true with respect to technology, with respect to the way we deploy technology in the healthcare system, for instance, among something, the way we're communicating, the way we're having this conversation, and so
well,
on.
Let's hope that compression of time and that $10 trillion can be deployed in economically productive ways, but also for the advancement of something like the challenge of climate change. Take some of that $10 trillion and build a low carbon infrastructure world, or some ideas that where those two integrate, rather than throwing $10 trillion in the bin. We must leave it there, Martin. Thank you so much for being on this week's Halftime Talk. It's a pleasure to have you, and we look forward to welcoming you in the Middle East sometime in the second half of the year, perhaps, all willing with travels. Thank you so much.
Thank you very much.